Gold has long been seen as the safest hedge asset. But in 2020, when borders closed and global shipping ground to a halt, the gold market experienced a rare delivery crisis. This revealed an important reality. Traditional assets can be disrupted by legal frameworks and logistics, while Bitcoin offers a new complementary option. From mid-2023 to mid-2025, gold rose from $2,600 to $3,400, about 30%. Bitcoin surged from $26,000 to $120,000, more than 350%. This reflects a growing demand for assets that operate outside traditional systems and allow free capital movement. In March 2020, border closures and logistics shutdowns stopped London gold bars from reaching New York, crippling COMEX futures delivery. COMEX required 100 ounces gold bars, but London's inventory was mostly 400 ounces bars. Immediate delivery is not possible. Financial institutions pressured CME to launch the Gold Enhanced Delivery contract, using ACE, accumulated certificates of exchange, to replace physical delivery. In reality, no physical gold crossed borders. Meanwhile, stop delivery contracts surged, and the price spread spiked to $60 to $70 per ounce, the widest in nearly 40 years. Based on COMEX data, April delivery contracts jumped due to border lockdowns blocking gold transport. June surged again, driven largely by CME's paper-based delivery solution. No actual gold moved. Hedge funds failed to deliver, and the exchange had to change rules mid-crisis to stabilize the market. Gold didn't crash in price, but its liquidity broke down, exposing the operational risks of physical assets under systemic or logistical stress. Bitcoin doesn't need borders, vaults, or shipping. With a private key, transfers can be made anytime. No bank approvals, no fear of being blocked. It is the only asset fully driven by technology rather than institutional control. Beyond investment, it's a tool for cross-border asset transfer and even a mechanism for de-dollarization. The US moved from trying to suppress Bitcoin to seeking control. Approved Bitcoin ETFs, introduced stablecoin legislation, opened regulated exchanges and built monitoring systems. Why? Because on-chain assets are no longer just for retail investors, they are now treated as strategic tools at the national level. America's strategy of open access plus tight regulation aims to maintain dollar dominance while preventing capital from fully escaping into the Bitcoin system. Bitcoin brings freedom, but also high risk. Lose your private key, and your assets are gone. Regulatory crackdowns or replacement by new technology could wipe out value. Hacks, cryptographic breakthroughs, or even a sudden loss of market confidence could cause its price to collapse overnight. I'll be releasing a video to discuss this in detail. By contrast, gold is tangible. Stealing gold requires manpower. Stealing Bitcoin? A single hacked computer could be enough. Gold still anchors global reserves because it is physical and cannot disappear. It has thousands of years of proven value. It is globally recognized with strong liquidity. In 2024, central banks bought over 1,000 tons of gold for the third straight year. In Q1 2025, another 244 tons were added, led by Poland, Iran, Kazakhstan, China, and Turkey. Nations use gold to diversify away from the dollar, proving its role as the foundation of de-dollarization strategies. Gold remains the bedrock of stability. Bitcoin is the flexible, cross-border complement, but not a replacement. Future hedging won't be a choice of one or the other. Will the new gold plus Bitcoin combination become the norm? Meanwhile, BRICS nations are actively working to reduce dollar dependence, from local currency settlements to exploring new payment systems. They are still searching for a clear path forward. BRICS seeks to rewrite the rules within the system. Bitcoin bypasses the system entirely through technology. One is negotiation, the other is circumvention. They are not necessarily in conflict, but together, they reflect a world where US dollar dominance is no longer taken for granted.